Okay, so let's get started. What the heck is a HECM? Home equity conversion mortgage. So if you take HECM and just dissect it, all right, we all know what home equity is, right? Home equity is home equity. It is the asset that you own, home equity. And we're going to convert that into a mortgage. A lot of people want to take something that's called a reverse mortgage and they want to just confuse it. At the end of the day, all we're doing is taking home equity and we're going to convert it into a mortgage. It just so happens that this mortgage does not have any required monthly mortgage payments. That's pretty cool. No required, keyword being required, monthly mortgage payments. Now, with any mortgage, your homeowner is required to upkeep the house, to pay the HOA dues, pay the property taxes, the homeowner's insurance. There's responsibilities with being a homeowner. But I want to go way back to 1961. So what is that? 65 years ago. And I don't want to bore you with history, but I really think it helps to understand why this program is called a reverse mortgage as opposed to the legal name, which is a HECM, home equity conversion mortgage. So first of all, in 1961, the story goes that little old lady lost her husband. Very small town in Portland, Maine, very small savings and loan called Deering. The little old lady went to her banker and said, I'm in trouble. My husband died, my income mostly died, and what am I going to do? I'm trying to live on Social Security, but I'm broke. And the bankers, so she's applying for a loan, and the banker says, I'm sorry, you don't have enough income. You're a woman. Believe it or not, those are the sign of the times, and there's nothing we can do for you. And she said, well, what if and I'm summarizing the story, what if I gave you my house? Would you give me some money? The bank's like, well, we don't do that. You don't qualify. And they spoke about it. It's a small town, it's a small savings loan. She was a popular wife of the most popular high school uh, coach, basketball coach, and football coach, I'm sorry. And the banker worked out a deal. He said, okay, I tell you what, we'll loan you money against your house, and the loan will be paid in full when the one second. So the loan will be paid in full upon your death when the bank gets your house. And there was the birth of the reverse mortgage. And it wasn't called necessarily a reverse mortgage back then, but that's what it was called. And what was interesting is that this was the beginning of something that no one knew what was coming. In the 60s, there was congressional hearings about this concept. Does it make sense for someone to give their house away in exchange for money? And perhaps this is where the whole thing came about, where if you do a reverse mortgage, you're going to lose your house. Perhaps. No one really knows. But the United States government took interest in this. And the Senate Committee on Aging had hearings. They used a professor named Young Pin Chen from California, UCLA professor, to sort of help explain this and talk about the concept, which had a lot of good publicity, had a lot of good interest in it. So in the 80s, there was a lot of private stuff going on where people were taking people's homes in exchange for money, and it's not a bad thing. When we're dead, we're dead. There's nothing going with us, right? But Senator John Hines back in the early 80s was proposing the some kind of a government insured plan, and maybe it would fall under HUD, maybe it wouldn't. But finally, they decided in 1987 they passed an FHA insurance bill to put some kind of a reverse mortgage kind of a program under the direction of HUD, Housing and Urban Development. And that was the birth of the home equity conversion mortgage. And back then it was a demonstration. It was just a test. Will allow up to 50,000 loans in the United States to be generated, and we'll see how this thing works. In 1988, Ronald Reagan signed it into law, and it became a refinance program. Now we're going to be talking about the purchase program mostly today, but it became a refinance program. And from 1989 to about the year 2000, it was really a little known program that FHA offered. Oops, excuse me. The FHA offered. It really didn't take any hold. And whatever media attention it got from the 80s through the 90s was mostly negative. And there were some horrible stories. There was even programs like equity share reverse mortgages. In other words, not only do we want our money back, but we want some of the future value of your house. We want some of your profit. And those things went away. There's no such thing as an equity share program, at least not under the umbrella of the federal government. In the year 2009 and 2010, during the Great Recession, the federal government decided to expand upon the HECM refinance program to allow for a HECM purchase program to try to stimulate the economy.
30 pages.
It had been in the conversations for probably more than a decade. If we can refinance a house, how come we can't buy a house?
Let's go way back here.
So it finally was passed into law.
Talk about a fast forward that was.
It was supposed to be in 2009, but there was a lot of bugs in it. And I've been in the business, by the way, since the year 2000.
So
this is my 26th year. So let's go back to, in reality, once the bugs are worked out, the housing recession just for a moment. And by the way, if there's a question,
the reason
please,
that's important,
I've lost the video, because that was 16 years ago. Now, I wish
I can't have everything in the world.
Class,
I can't see anybody
raise your hand right now. How
I'm
many
assuming
people
everyone's still there.
Knew that you could purchase a home with a
let me see if I can find people.
Reverse mortgage, right? Well, according to NAR, only 3% of all the licensed real estate agents across the 50 states and the territories have even heard about a purchase reverse mortgage. They've never even heard of it.
See if I can
now, they may have
put
heard
this
of a
on top
reverse
so I can
mortgage.
see everybody.
Interesting enough, a lot of people haven't. And if they have,
this is crazy.
They don't really understand.
I've been on Zoom for years.
What exactly is a reverse mortgage?
Since 2000 anyways.
Oh, that's where the bank takes your house.
For some reason, I'm having trouble.
Oh my gosh, here we go again.
Connecting, seeing
So one of the
people.
things that I did, oh my gosh, 15
By the way, good morning,
ago,
Tony.
16, 17
we're supposed
years
to have
ago,
17 to 20
is I
people,
decided to get the word reverse mortgage
me, so I don't know what happened.
out of my system.
Even my
out of my language.
Here, so
now,
I'm thinking maybe
I can't.
Maybe there's a problem with
I can't get it out of my language,
people.
and here's why. And let's use a dog as an example. A little cute poodle at the top of your screen.
All
right, that's a dog.
Drag.
No, it's a poodle.
Bar.
You know why that's a poodle? No. Because poodles are different than German shepherds, Rottweilers.
I also have to speed up since I'm.
They're a different breed.
Everyone's time
it's a different kind of dog.
I'll have to just talk faster. That way we get done faster.
If you are a breeder and you're selling Chihuahuas, then you would advertise Chihuahuas.
All right, we're going to share the screen.
Doberman Pinschers or Dalmatians. You'd be advertising Dalmatians for sale, not dog for sale. Oh. You need to be specific. So the HECM, home equity conversion mortgage, is a reverse mortgage. It's a type of reverse mortgage. The FHA HECM happens to be the safest loan in America. Now that I can see the safest mortgage in America. If you want to raise your hand, if you have a question, or type something into the chat, or take yourself off mute. One of the cheapest, as far as the interest rates with me, I'd love to have and such. It's definitely the safest, and it's 100% what senior citizens should be doing. Not every senior citizen, because there's never a perfect product for everybody. But let's expand upon that. If for anybody out there saying, I don't quite get it, then let's use an analogy of a fruit, right? A lime is sour, a strawberry is sweet, but they're both fruits, right? If you're going to open up a fruit stand, that's fine if you sell everything. But if you sell strawberries in Plant City, you're not going to open up a fruit stand. You're going to open a strawberry stand. People are going to know they're going in to get strawberries. So what I employ you to do is to get reverse mortgages out of your language. You'll never get it out of your language. But call a HECM a HECM. Call the FHA HECM a HECM. Now, the disadvantage of that is, well, I don't know what a HECM is. Well, it's a home equity conversion mortgage. It's the safe type of reverse mortgage. It's the safe type of reverse mortgage. Oh, okay. Now, all of a sudden, you've got a customer who's listening. Well, tell me more. I don't like reverse mortgages, but tell me more about this. What'd you call it? A HECM? Tell me more about the HECM. Now you've got their attention, as opposed to, don't tell me about a reverse mortgage. Everyone says that that's where you should run. It's the worst loan out there. It's the loan of last resort. Anyways, what that slide is saying is this program that came out in 2009, 2010 officially, and that we are going to be talking mostly about the HECM for home purchase today. So let's go back to the reverse mortgage. And here's another reason why I want us to sort of quit talking about reverse mortgages as the primary word to introduce this program, is because it's not the only reverse mortgage. The FHA HECM or proprietary HECMs are not the only type of reverse mortgages. The Federal Trade Commission recognizes three types reverse mortgage. First of all, the FHA HECM, which was mostly what we've been talking about right now. The single purpose reverse mortgage, which is really just some kind of a property tax deferral that every county in Florida offers, and probably most counties across the United States. And what the single purpose property tax deferral reverse mortgage is allow people that are of limited income, that are of a certain age, typically age 75 and above, but every county is different, that if they can't afford their property taxes, they can put it on the end of their life. And when their home is sold sometime in the future, then all the back property taxes can be paid up. But that way they're not in default. The deed is not going to be sold in the courthouse steps. It's just a deferred way of paying of property taxes. And if somebody can save $2,000 a year on property taxes because they're on a fixed income, and that $2,000 a year changes their life, then it's a great program. But it's only, $1,000 a year. It's only $2,000 a year in tax savings. Why not just do a HECM and get a more money, more income, and have a better financial life in retirement? Everyone has their own goals. Not every product is right for everybody, but that program is available in the state of Florida. And then the third type of reverse mortgage that is recognized by the Federal Trade Commission is the proprietary private loan reverse mortgage. And there's a whole bunch of them out there that are really good. There's definitely a few bad ones. There's always bad apples. But the proprietary typically is a great alternative for the FHA HECM. And the reason is because they'll do a HECM reverse mortgage on things that FHA won't. Condos, for example, are hard to get FHA financing. Multi-million-dollar homes, FHA won't touch them, or if they do, they'll substantially reduce the funds available as compared to a proprietary. The proprietary typically has easier underwriting, not that the FHA HECM has difficult, because it doesn't. The proprietary just fits when it fits. And interesting enough, 40%, I kid you not, 40% of all HECMs that are written today are actually proprietary HECMs, not the FHA. So they're obviously doing something right. They fit where they fit. For example, I'm doing one right now where there's not enough money coming to the customer at the time of closing to make the FHA HECM work, but one of the proprietary companies has a second lien position reverse mortgage. In other words, what my customer is going to do is they're going to leave the first mortgage in place. The customer is going to continue making a mortgage payment on a 3% interest mortgage on their first mortgage, and we're going to come in with a HECM second mortgage. What a concept. And now she's going to be able to borrow $130,000 with no monthly mortgage payments for the rest of her life, but she still has to pay her first mortgage payment. So it's a situation where if she just did a HECM and eliminated her first mortgage, she'd get a little bit of money at closing because most of the funds would go to pay off her mortgage. And that's okay, because now she has no payments for the rest of her life. But she doesn't want to do that. She has a bunch of credit card debt, and she wants to pay all those things off, which is good for her because those are 20%, 30% interest. So she's going to do a second, eliminate all her credit card debt, still have cash to spend, and continue to make her payments on her first mortgage that has a low interest rate. It makes great financial sense. Totally support it. So I'm just going to sort of beat a dead horse here. The FHA HECM is not the only reverse mortgage. Okay, it used to be 98% of all reverse mortgages written in the country was the FHA HECM, but that has changed due to a lot of things. A lot of things have changed, and in a good way. But even though the proprietaries have taken a very strong hold, 40% of the industry, the FHA HECM happens to be the best and the safest kind. It's sponsored by FHA. It's insured by HUD, right? There's no better insurance than being protected by the federal government, because the only way that something bad can happen is if the federal government goes out of business. And if the federal government goes out of business, well, we're all in trouble, right? We're all in trouble. If a bank goes out of business, if an insurance company goes out of business, okay, so that affects a lot of people. But if the federal government goes out of business, everything goes out of business. So without argument, it's the safest insurance you can have is the federal government. So the FHA HECM has a fantastic reputation. It's been around for 35 years. It has a 96% satisfaction rate. That's like a 4.9 star rating out of 5 on Google reviews. That's just about perfect. So when someone says, yeah, reverse mortgages, HECMs, they're bad, they don't know what they're talking about, because of the people that have done them, they realize that they're an amazing program. There's no required monthly mortgage payments. How many people, if they could eliminate their mortgage payment and still own their house, would go for it? If you got a letter in the mail and your mortgage company, the one that you have right now, thank you. I got a thumbs up on that one. If you got a letter in the mail right now and your current mortgage company said, you know something, we're changing the rules. You no longer have to mail that $2,000 monthly mortgage payment in. Now we want you to, of course, but if you want to skip a mortgage payment, go right ahead, no charge. We'll just defer the interest to the end of the loan. You can pay it after you die. You can pay it when you sell your house. If you just have the option, just as an option. Maybe December, because it's Christmas time, you just want to, skip a payment. Or maybe you want to take that 30-day cruise somewhere. You want to take a 2-week cruise to Australia and back. Skip a payment. Skip a payment. What the heck? How many people would say, I'll consider that, sure. Well, how about retirement? Would you like to skip a payment for the rest of your life in retirement when you're living on a fixed income? Well, that's what this program does. And once people understand it, they love it. So the HECM for home purchase, just like the refinance, has no required monthly mortgage payments. Now, in order to purchase the house with a reverse mortgage, with a HECM, you have to put a substantial down payment. So let me go back to a refinance just for a moment. If you were to own I'm going to keep it simple. I'm going to say a $500,000 house, just because that's kind of like a round number. Now let's do a $300,000 house. You can't buy a house for $300,000 anymore, pretty much, right? They're $400,000 on average. But okay, we'll do $400,000. All right, here we go. $400,000. I want to be consistent. Whatever I do, I want to be consistent. So we have a $400,000 borrower, and to keep it simple, we're going to say there's no mortgage on it whatsoever. Based on their age, the older a person is, by the way, the more they can borrow. And the reason behind that is, well, they have a shorter life expectancy. So there's a shorter life expectancy for somebody who is older than someone who's younger. The minimum age for the FHA program is 62 years old, and the minimum age for a proprietary HECM is 55 years old. And the younger you are, one more time, the less the program will allow you to borrow. So we're just going to throw out an age of, let's say, 70, $400,000 home, and they already own it. They happen to have no mortgage. Based on this person's age, based on the current interest rate, based on the appraised value, they might be able to borrow 35 or 40%. So 40% of 400,000 is $160,000. So they can borrow on a refinance program. They can borrow $160,000 on a $400,000 house. And the first knee-jerk question would be, well, hang on a minute. How come it's only $160,000 on a $400,000 house? That means there's a lot of equity in that house. Yes, there is. Because the lender, in this case FHA, is not looking to buy the house. They're wanting to make a loan that does not require a monthly mortgage payment, knowing that with interest rates being around 6% for the HECM, and no one's making a payment, that $160,000 loan balance is going to increase. Next year, it's going to be higher than 160 because interest is accumulated. Now, the house will be worth more next year, right? 4% on average is what most people use as a statistical increase in value. So the house is worth $416,000 next year. The loan balance has gone from 160 to 169, let's say 170. So the loan balance is going up, but the home value is going up. So FHA never wants to be in a situation where they own the house. If there's ever a situation the house falls in value, there's a non-recourse feature we'll talk about later kicks in. But they're not wanting to buy the house. All they're doing is loaning money without a mortgage payment. So now let's flip over to this page. Now a person is purchasing a home. They're going to purchase a home using a reverse mortgage, a HECM. So the same thing applies. They're not going to lend $400,000 on a purchase. They're going to lend about $160,000. Which means that the difference, the $240,000 difference, has to be paid for as a down payment. So the example in front of you is they can purchase a $400,000 house if they're able to put down 65,000 or 65% or maybe 60% in that range. They got to put down a substantial down payment. And then some of you would probably say, well, hang on a minute, that's a lot of money. My clients don't have that kind of money to put down on a house. Well, then this isn't their program. Perhaps a FHA 3.5% down, conventional 20%. Maybe they just make payments for the next 30 years. That's okay. Not one program fits all borrowers. But here's where it comes in. All right, listen to this. If you haven't listened yet, listen to this part. A customer comes to you. They're moving to Florida because they heard Florida was cheap, low cost living, no income taxes. And they bring $250,000 cash money with them, thinking that they're going to pay cash for a house and live happily ever after. All right, now your brain's already with mine. I know it is. And they're sitting down with you, and they're all proud of themselves. They got $250,000 they've been saving up. They sold their house up north. They're moving to Florida. They got $250,000 cash. They got cash. Now, hang on a minute. This is a retirement home. Now they want a swimming pool. They want a jacuzzi. They want to be on the golf course and a 55-plus community. They have requirements. And they got $250,000 for the down payment to pay cash for a house. And you're a professional real estate agent, and you're just sitting back shaking your head and thinking that you probably can't even get them a manufactured home for that price, not for all the things that they want. So now you're talking to them about getting a mortgage in retirement, and they don't want a mortgage in retirement. But then you remember, well, hang on, there's this HECM for home purchase program. What if I were to show you, Mr. Customer, where you can purchase a $400,000 house? And it may not be on the golf course and probably won't have a swimming pool, but if I could get you into a $400,000 house with no monthly mortgage payments for the rest of your life, and you still own the house, and it's going to cost you $240,000 down, including the closing costs, by the way. $240,000 down, you're going to own it. Would you be interested? And what's interesting, if you said, I'm going to help you purchase a home with a reverse mortgage, they'll probably shut you down. But I'm going to help you purchase a home using a HECM, an FHA HECM. And they're going to say, oh, wait, no mortgage payments? I don't know what a HECM is, but I'm interested. So here's the game changer. So I'm going to say one more time here. I'm going to say it again later. But get the word reverse mortgage out of your language. This is a HECM, home equity conversion mortgage. This is a HECM. And we are going to be focusing on the HECM for home purchase as opposed to the HECM refinance. But this is the HECM for home purchase. Now, you, Mrs. Realtor, just made a $400,000 sale where you may not have not using a HECM. You would have helped a retired couple get into a home with a mortgage payment for the rest of their life, into a home that they may not be able to afford in the future on the loss of a spouse, when one of the spouses pass away, or they have some unexpected health care costs, or they have to spend money on something they weren't planning on spending money on, and they're out of money, and they're in retirement mode, not looking for a job at age 80. All right, now you're able to help them buy the house that they wanted with no monthly mortgage payments and change their financial future forever. So all HECM for home purchases, whether it be proprietary or the FHA type, have no required monthly mortgage payments. All of them. So let's look at things in a different way. We're going to sort of reverse the reverse. If you thought you were confused up to this point, what do you get done with this screen? So rather than talk to somebody about 65% down, okay, because the knee-jerk reaction one more time is 65% down is, well, that's a lot of money. What about 20% down? Well, no, this program is 65% down, but there's no mortgage payments. The other thing is, well, how do you do the math in your head? A lot of people can't do 65% math in their head. It's difficult. You get your calculator out, you got it figured out, right? But so let's look at the bottom half of the screen where it starts in red. It says get a 50% boost in purchasing power. So you're out in the field, you're talking to a customer, and someone says, and you're asking questions, and they tell you that they have $200,000 cash money. Well, let's say $300,000. Let's stick with the examples on the screen. They have $300,000 cash money, and you don't want to be taking, 300,000 and doing the calculation of 65%, or you don't want to be taking the purchase price and subtracting the. Instead, look at it like a purchasing power boost. The federal government, FHA, will help you purchase this house with 50% more purchasing power than the cash you have available. In other words, $300,000 cash gives you half of 300,000, 150. Will give you a $150,000 boost in your purchasing power. $300,000 cash gets you a $450,000 home. $400,000 adds 200,000 to that, gets you a $600,000 home. You get a 50% boost in purchasing power using this program. And now all of a sudden, this program is not only easy math for your head, but it's definitely a positive because now there's a boost in purchasing power. $600,000 down payment gets them a $900,000 house. Now let's go back to reality just for a moment. $600,000 cash buyer. You're excited, right? You're having a cash sale. You're getting paid in 10 days, maybe less. You're having a cash purchase. You got a $600,000 purchaser, all cash, right? We're all excited, except the $600,000 neighborhood that you take them to isn't the house they're looking for. It's not on the golf course. It's not in a 55 plus community. It doesn't have the jacuzzi or the swimming pool. It doesn't have the big kitchen with the open floor plan. It doesn't have the 4 bedrooms for a 2-person family. It doesn't have the room for a billiard table. It's not the house they want, but they also don't want a mortgage payment. And then one more time, you remember this HECM for home purchase class, you realize that you can take them to the $900,000 neighborhood with the 3-car garage and the bigger pool and the nicer kitchen and the 5 bedrooms and the 4 baths. I'm exaggerating now, but the point is that now you're selling a $900,000 house and your commission is based on the $900,000 purchase, not the $600,000 down. I haven't had a question yet, so let's have a question. Anybody? All right. While you're thinking of a question, let me catch the people that came in late up just a little bit without boring everybody else. So we are approximately 30 minutes into the program, and this is being recorded, as you probably all know. And this recording will be available to everybody that's on this call. And Don, say hi, Don.
Can you hear me?
Yep.
So Don will make sure that everyone gets a copy of this video who wants it, a copy of the slides if you want it. We'll make all that available to you. And Don will also be reaching out to everybody to make sure that he has your license and your phone number, your email address. He's going to make sure he has all the contacts so we can get you your 2 hours of continuing education credit. Don, you have anything you would like to say?
No, I apologize for was not available immediately. The computer's giving me a hard time. It's still giving me a hard time. But I will take care of all the information, getting to the people as next week sometime, getting them my information, making sure they have flyers, making sure they get their 2 CE credits, and helping them with any questions they may have, any clients that I can help them with. And I'm available all the time to assist them in any way I can regarding the reverse mortgage program. And I apologize. I just can't seem to get onto the. I don't understand what's going on now.
Well, you're not the only one. There's a whole bunch of people that couldn't get on. So
I know I sent a link to Katie at Bonita Springs. So maybe there's more people who come on. I don't know, but
Yeah, I never got the link, so I contacted Kaylee this morning, and she sent it to me, so I was able to log on.
well, that's good. Okay, good. Okay.
So one more time, whatever you missed, you can watch the recording and get you caught up. So make sure everyone gets their 2 hours of credit. Also, I have not yet introduced myself, and that's probably a good thing. So I don't have to introduce myself twice. So my name is Tim Linger. I'm a certified HECM specialist. I'm a certified senior advisor, and my most precious, my most, oh my gosh, I just turned 60. So the day you turn 60, is when your memory goes out the window. I've learned that from experience. But my most prestigious, thank you for laughing. My most prestigious credential is my all right, Tony, got a laughter emoji going through the screen. That's cool. My most prestigious designation is Certified Reverse Mortgage Professional, CRMP. And the reason that is because our industry, just like NAR, just like realtors, can get designations based on if you're a SRES or commercial real estate specialist or so on. Well, we have one, the CRMP, and it's a really hard designation to get, and it's limited to just certain experts in the industry. And I happen to be one of only 200 in the entire nation. So, if you will, you're being educated by an expert of experts. If I could just pat myself on the back, I've been in the industry for 26 years. And I'm proud to say that I've never done a regular mortgage. And I say that because I love the HECM. And I know everything about HECMs, whether it be a proprietary or municipal kind of reverse mortgage, or the FHA, which I did almost all my loans through the 26 years. The proprietary mortgages have come to the surface over the last couple of years, and they're selling like hotcakes because it makes a ton of sense. The proprietary HECMs are an amazing program because they'll do about any program out there, from multi-million-dollar homes, $30 million homes, waterfront homes. They'll do about anything. Condos, the FHA HECM has their place. There's lending limits of 1.2 million, which is a lot of money, but the proprietaries don't have caps. $20 million home, $10 million home, fancy homes. So they just fit so many places. On top of that, not everyone waits to 62 or 67 to retire. Some people want to retire at 55, and the portfolios offer programs starting as young as age 55, and that's cool. The loan to value is not super great because it's a young age, but it fits where it fits. People that are wealthy are typically wealthy because they use other people's money to get wealthy. You know, they buy homes, they flip them. They may use hard money to be able to buy a home in order to flip it to make money, right? So a lot of wealthy people, especially in the multi-million-dollar homes, will use a proprietary to free up capital so they can use it to get richer. So it makes sense to use money to make money. All right. Any questions yet?
Nope.
I have one quick question.
Okay.
Okay. I just want to be clear that you said that there's no mortgage payments, but just to be extra sure about the property insurance, the property taxes and the HOA, you said they're still responsible for that, correct?
Yeah, absolutely. So, yeah, so to answer your question very quickly, and then I'm going to expand on it, is the person is responsible for everything except the monthly mortgage payment.
Okay.
So if the community has an assessment, let's say a condo all of a sudden has an assessment, the homeowners association has an assessment, they got to pay that. HOA, homeowners association dues, condo association dues, property taxes, homeowners insurance, they have to pay all that. As a homeowner, you have to pay that. The roof leaks, well, you got to fix it. The house needs to be painted, we got to paint it. Right? Your job is to maintain the house and pay all the fees. The only thing that's eliminated or delayed, let's use the word not eliminated, but delayed, deferred, is the mortgage payment. Now, I've had people say, well, why does the government give away money? No, remember, this is a mortgage. The other word for a mortgage is a loan. This is just a loan. You still owe it. You're just not making payments until it comes time to make payments. And when the payments are due, they're doing one payment, the whole thing. Typically, a person will do this in retirement at age 62 or over and have this loan for the rest of their life. If they live 40 or 50 more years, it's a lifetime loan. And when they're done, because they've died, the loan comes due. Whoever inherits the property most likely will sell it, pay back the loan, keep the profit. So it's a deferred payment loan. That's just the simplest way. In fact, this is a good time to explain what I always say to my customers, because as simple as this program is, this is, in one sentence, this is just a mortgage with optional payments. Take that and digest it. This is a mortgage with no required payments.
Is there income limits?
No. There is a minimum income. There's no maximum. You could be a multi-millionaire with lots and lots of cash flow. It doesn't matter. But on the other side of the spectrum, a person who is broke, right? They still qualify too. We don't have a credit score requirement, at least not for the FHA version. We don't really have an income requirement either. However, FHA says that, can you afford to live in the house that you're living in? Can you afford the property taxes and homeowners insurance? If we eliminated your mortgage payment, do you have enough income to be able to pay the taxes and insurance? If the answer is no, well, then they're not going to do the loan because they know you're going to default on the taxes and insurance, right? That's just logic. So FHA in 2014, after the housing crash, because prior to 2014, which was 18 years ago, prior to 2014, if you were 62, owned a house, and had a pulse, you qualified. I kid you not, everybody qualified. But what happened in the housing crisis was that people were, I don't know, living off their savings or something, but it came to a time where they couldn't pay their property taxes, their homeowners insurance. They didn't have enough money. So they went into default. And the federal government, they foreclosed on a lot of homes with HECMs. It's not a good reputational risk to kick a senior out of their home. They lost their home because of a reverse mortgage. No, they didn't. They lost their home because they didn't pay their property taxes. It just so happens that the lender at the time happened to be a HECM company, a reverse mortgage company. But the reverse mortgage didn't cause the foreclosure. The lack of paying property taxes called the foreclosure. So this is what I say to all my clients, to help them understand, to help them grasp. Oh, I'm sorry, let me finish what I was saying. So the minimum income for a single person is $527 a month. All right, that's pretty low income, right? That's so they can eat, because we all have to eat. The $527 a month was determined by the federal government, that if they don't have at least $527, then how can they eat? How can they pay their light bill? How can they pay their water bill? How can they have a cell phone? Right? That's just the basics that's not even the basics of life. But 527 was determined that that's the minimum for a single person. It's 886 for a couple. Plus, how much is their property taxes and homeowners insurance? So if the property taxes are, well, let's just say they're 100% disabled veteran, there is no property taxes, at least in the state of Florida. So their homeowners insurance is $200 a month. So 527 plus $200 a month is 727. That would be their minimum income in order to do a HECM. So it's pretty much low. If their credit score was 350, which I think is the lowest you can possibly have, they would still qualify, as long as they showed the willingness to pay their bills on time and the ability meaning how much money they had coming in cash wise, to pay their bills. If they have a bad credit score, we would just say, well, why? They wouldn't be declined because of their bad credit score. We would say, well, what happened to cause your credit score to be so low? And if they could provide a plausible explanation of that, we call that a life event, then they qualify. So this is probably one of the easiest loans to qualify for, because the government is forgiving when it comes to senior citizens in this program.
Now, I have another question, if you don't mind.
Sure, please.
In regards to this, like, do they do refinances?
Yes. So
like a typical mortgage, say we have a normal 30-year mortgage and we can get someone to refinance it into this type loan.
Correct. Yes. So these HECMs have two options. They have a purchase option, which is mostly what this class is about. We're going to help realtors sell more homes using the HECM for home purchase. And how the program originally started way back in 1988, 87, 88 was it was a refinance program. So you already had to own a house and you wanted to refinance to pull some equity out of it. That's a refinance. And it doesn't mean that your house had to be paid for. It just means that the numbers have to work. If somebody lives in a $400,000 home and based on their age, they're eligible for $200,000 in loan proceeds, but they had a $150,000 mortgage,
the first thing we would do is pay off that mortgage. The second thing we do is give them the difference, $50,000 at closing. So yes, to answer your question, we can refinance an existing mortgage. We can actually refinance an existing HECM. We can do a HECM to HECM refinance. So yes, we can refinance an old regular mortgage into a HECM. We can refinance a HECM into a HECM, and we can help people purchase a home using a HECM. If you use this as an option, as a loan option, I know you're real estate agents, not loan officers, but if you use this as a way to increase your the sales price of your properties, or help people that would not otherwise get approved for a loan buy a home, then you're earning more money. And if you make one extra sale this year because of a program like this, and your average commission is whatever, $10,000, then that's $10,000 more income in your pocket. And you've got a happy customer for life. The other question we had, which we're actually going to cover later on, but I'm going to answer the question now. Approximately, what is the interest rate? Well, for the FHA, it's approximately 6%. It's an adjustable rate it's based on the Treasury bill, so it could be 6.25%, but it's in that range. The proprietary programs, the non-FHA programs, are more like 9%, and that may seem high, but interesting enough, most people want what they want, and if they're not making a mortgage payment, so is the interest rate super important? Well, sure, it's always important. But does it deter people from doing a HECM because the interest rate 9% on a loan they're not making payments on? Usually not. So it fits where it fits. Closing costs on proprietaries are typically cheaper than the FHA HECM, but the closing costs are rolled into the loan and they don't take from the borrower's money, which means, are the closing costs important? Well, sure they are, because somebody's got to pay them eventually. But does it really matter to our borrower who is not taking the house with them when they die? Usually not. Usually it's just it's a hiccup in the road that people have to understand and get over it. Closing costs aren't cheap with the FHA program, and that's mainly because FHA charges a 2% fee based on the appraised value to insure the loan, which we'll cover in a little bit. In other words, if your customer's buying a $500,000 house, FHA fee of 2% is $10,000. The closing costs are $10,000 higher just because of the FHA insurance. But the insurance is worth its weight in gold. Again, we'll go over that in a little bit. It's why there's a non-recourse feature. Then you have your typical closing costs, the doc stamps, intangible tax, title insurance, recording fees, and that runs, 1.5 to 2 points of the home's appraised value. And then you have the lender's fee. Lender's fee is anywhere from $2,500 to $6,000, and that's what some people would call as points. We call it origination fee, but whatever you call it, it's what the lender charges to process the loan, to underwrite the loan, to pay commissions. It's their overhead, and the minimum is $2,500, the maximum is $6,000, or it's 2% of the appraised value as long as it fits within that $2,500 to $6,000 range. It's probably way too much information, but we'll go over it again in a few slides. And let me minimize. I have Don here. Okay, how do I get rid of Don? Sorry, Don. You're on my whole screen. I don't know why. I don't know why you're on my whole screen, but you're on my whole screen. I need to get back to my slides. I just got to figure out how to do it. All right. Let's see. I may have accidentally pinned you. I gotta unpin you if that's what I did.
I can knock myself out. How's that? I just have my
that
name.
didn't. All right. If I kick you out by accident, just rejoin.
I do have one question on something
Yeah.
you were just mentioning in regards to the FHA. What is is it the same FHA like amounts that are like the maximum mortgage amounts as they are for regular FHA mortgages?
No. No. Can everybody see all the words on my screen?
Yes.
Okay, good. No, FHA HECM is different than FHA financing. All the rules are different. So an FHA financing, it's a 3.5% down.
and they have credit score requirements, they have income requirements, they have debt to income requirements, they have a fee for their PMI. It's a whole different set of rules. And then there's the HECM. And yes, we fall under the uh, HUD umbrella under the FHA division, but we're its own division under FHA, and regular FHA loans fall under another division. So all the rules are different. Whatever you think you know about FHA financing, you can just forget about, because we don't do it on our side. Does that answer your question?
Yep, thank you.
Yeah, I get that all the time. I get people that say, "Well, yeah, I do a lot of, I'm a realtor and I'm a loan officer, and I know all about that," but they don't, right? FHA, we don't have a minimum income. We do $527. We don't have a debt to income ratio. We don't have a credit score requirement. It's just different. Okay, so finally back to the screen. I always say this to my customers, because reverse mortgages is it's a weird word. What do I mean reverse mortgage? So I use forward mortgage for regular loans, because you're forwarding a check to the bank every month. And you could think that a reverse mortgage is where the bank pays you, whether it be monthly or a lump sum. So therefore, with a regular mortgage, a forward mortgage, if you're always forwarding a check, eventually your house is paid for. So a reverse mortgage, logically, is if the bank pays you, that eventually you don't own the house. And so people want to take something that's as simple as, remember what I said before the break, all this is a mortgage where payments are optional, right? It's just that simple. One sentence. It's a mortgage with optional payments. But they want to take this and they want to complicate it. It's as simple as what I just said. So a mortgage, this is what I say to my clients. A mortgage is a mortgage is a mortgage, right? Call it a USDA mortgage, call it a VA loan mortgage, call it an FHA, call it conventional, call it traditional, call it what you want to call it. But at the end of the day, a mortgage, right, in the simplest of terms, a mortgage is where a bank loans you money and they put a lien against your house to secure their debt, to secure the loan, right? That's what a mortgage is. It's a promise to pay back money that you borrow, and the bank puts a lien against your home. That's a mortgage. So what makes a reverse mortgage complicated? Because people don't understand it. So they want to complicate it. They want to fear what they don't understand. But at the end of the day, a mortgage is a mortgage is a mortgage. It's where you borrow money and the bank puts a lien against your house, right? So then the next question is, well, okay, if that's true, then what happens when I die? Well, the answer is the same as whether it be a forward or reverse, or a USDA or a VA. The answer is still the same. Your house is going to go to your heirs. Whether it's reverse or forward, your house is going to the heirs. If I were to die, let's just say I have a $500,000 house, and let's just say I owe $400,000 on this $500,000 house as a mortgage payment, and I die, knock on wood, during the middle of this class. My daughter and my son are going to inherit my $500,000 house. Plus, they're going to inherit a $400,000 forward mortgage. What are my kids going to do with a $500,000 house with a $400,000 mortgage? They're going to sell it. My son lives in Tokyo. My daughter lives in Orlando. I live in Orlando. And neither one of them want my house. They want the money. They don't want the house. So, and then what are you going to do with one house and two kids? You're going to sell it. So they're going to sell the house for $500,000. They're going to pay back the $400,000, or they're going to keep the home equity. And they're going to divide it in half. So whether I have a reverse mortgage, I'm 60, so I'm not 62 yet, or a regular mortgage, the answer is the same. Okay. What if you want to sell the house while you're still alive? You want to move to South Florida for retirement. Okay, I put it up for sale. I pay back the money I owe, and I take the profit with me. Well, what happens if you want to add a swimming pool in the backyard? Okay, I hire a contractor and put a swimming pool in the backyard. Remember, this is just a mortgage with no required payments. Nothing changes. I'm going to have purple carpet and yellow walls, black ceilings. It's my house. I got to pay the property taxes, the homeowner's insurance. It's my house. I better pay the HOA dues, or they'll come calling, right? But it's just a mortgage with no required payments. And who doesn't want that? When it comes to, I've been teaching this class for more than 15 years. And I've had realtors say, yeah, that's a good program, but all my customers have cash. They all pay cash. Well, good. Congratulations, because that's what we need. We need cash paying customers. We don't need the 3.5% down, the 20% down. We need cash paying customers. What we want is people that either want to hang on to their cash for retirement, or they want a nicer house than they would otherwise pay all cash for. Those are our customers. So yeah, that's what we want too. All my customers pay cash too. They just get a nicer home for less cash. Okay, so the down payment for a HECM, whether it be a portfolio HECM or FHA HECM, is going to be somewhere between 60 and 70% of the purchase price. In other words, if they're 55 years old and they're buying a house with a proprietary HECM, they're probably going to put 70% down. They're gonna put $700,000 down if they want to buy $1 million house. But guess what? They probably weren't going to buy $1 million house until they found out that they could buy $1 million house with $700,000 cash. And you think people that are buying multi-million-dollar houses don't finance it? Oh, yes, they do. And they finance it with 9% interest rate loans. They can buy a $2 million house for $1.4 million down. Think about it. It's pretty cool. So here's a real life example of a HECM to home purchase flyer that we created for this realtor in the Villages. And if you ever want to call Bob, there's his phone number. He's a really good guy. And he lives in the Villages. He has his own HECM for home purchase. He does a lot of listings and advertises a lot of homes with HECM for home purchases. And not everyone buys a home with a HECM. Why not? Because they all have different reasons for buying the house with the funds that they're buying. They may pay all cash and don't need the extra money to put in their savings for retirement. Maybe they already have $1 million and they just feel like that's all they need. Maybe they want a regular mortgage. Maybe they're a veteran and they got a pretty darn good interest rate and they can afford the monthly payments in retirement. Whatever. But the point is that Bob advertises his properties, all of his properties, all of his listings. He advertises it with this flyer. If the house is empty, or even if it's not empty, he prints a bunch of these flyers up. We create it for him at no charge. The association does, and we give him the flyers. He puts them on the counter. He puts his business card, and of course his name is right there. And other realtors come in and show the property, and someone will pick up this and say, "Oh, this is interesting." So I can buy this house that's listed for $629,000. I'm 82 years old. I can buy this house for $350,000. Really? I can buy a $629,000 house for $350,000 cash money, including the closing costs? You sure can. Well, my wife is 72. Okay, we're going to use her age instead because it's the youngest person's age. So $411,000 down gets him a $429,000 house. How cool is that? So the rhetorical question of the day. I love this question. How many homes could you sell as a professional realtor? How many homes could you sell right now, today and today only, if all houses were on sale today and today only, for 30% less than asking price? The only catch is that your customer had to pay 100% of the 70%. There you go. There's a tongue twister. They had to pay all cash for the house. But today and today only, all houses were on sale. How many homes could you sell today? And the answer is all of them. And that's how you have to look at this. All homes across the state of Florida, across America, is on sale today and today only, and tomorrow and the next day and the next day. But they're all discounted by 30, 35, as much as 40%, depending on a person's age, as long as you have all cash. So let's talk about the non-recourse feature. I said multiple times when we started that this is the safest loan in America, and here's why. Here's the number one reason. And by the way, all the HECMs, whether it be FHA or the proprietary, they're all non-recourse featured loans. The difference between the FHA is it's backed by the federal government, where the proprietaries are backed by the investors. but they're both non-recourse loans. So what does that mean? So in the contract, it says that if anything bad happens to the loan, the lender were to fail, the lender doesn't honor the contract. Right now, we're talking about the FHA version because that's the one that's backed by the federal government. So the lender were to fail, the lender doesn't honor the contract, you have money in your line of credit, and they're not sending it to you after you requested it. It's just something bad happens. Or what happened in 2008, 9, 10, 11, homes go down in value. What if one day when your clients are done with this loan, they've died, they decide to sell and move, they've gotten sick, moved to a nursing home, when they're done with this loan, they're done with their primary home, and they go to sell it, and because they have not made a mortgage payment in 10 or 15 or even longer, their loan balance has gone up substantially, which was expected, of course, because if you don't make a payment, your loan balance goes up. But the home was supposed to grow in value too. It's supposed to grow by 4% a year, maybe as much as 7% a year since we live in Florida. But something happened. 2009, 2010 happened, and homes went down in value. And not only did they go down, but they tanked. Homes that were worth $200,000 in 2006 are now worth $100,000 in 2010. And for those of you who were in the business in 2010, you know exactly what I'm talking about. Homes dropped in value substantially. You could buy a pretty nice home for $200,000, $250,000 on the high side. Seriously, in 2006, an expensive home was $250,000, $300,000. That's an expensive home. That's the one with the swimming pool and the jacuzzi on the golf course. But we woke up in 2010, and that same home that was worth $250,000 is now worth $125,000. It dropped by 50%. Well, what happens if they borrowed $150,000 and now the loan is $200,000, but the home is only worth $125,000? It's upside down. It's underwater. But they're done with the house. Now, if they're not done with the house, it's a forever loan. You don't make a payment, you live there, you pay the taxes and insurance. But what if you want to sell the home and you owe $200,000 on a house that's worth $125,000? Well, that's where the non-recourse feature kicks in. You can say to FHA, here are the keys. I don't want the house. I don't want the debt either. And per contract, there's no IRS hit, there's no deficiency judgment, there's no credit report hit, there is no recourse whatsoever. No recourse whatsoever. It's a non-recourse loan. And the proprietary loans have followed FHA lead, except they don't charge a fee for the insurance. It's built into the interest rate. It's already calculated in. Where FHA has it a line item. They charge a 2% upfront fee for that insurance. So on a $500,000 house, FHA charges $10,000. Plus, we have closing costs, doc stamps, intangible tax, title insurance, and so on. Plus, you have a lender's fee of $2,500 to as much as $6,000, depending on the value of the house. So closing costs, side by side, a regular mortgage versus a FHA HECM. The closing cost for the FHA HECM is higher, mostly because of the insurance fee, than it is with a regular purchase. The primary benefit, other than the insurance, which is a huge part of this loan, which makes it the safest loan in America, is that the interest rate is typically a little bit cheaper with the FHA HECM, but more importantly is there's no monthly mortgage payments for life. There's no monthly mortgage payments for life. I have a required mortgage payment. I'm 60 years old. I've said that 3 times. I have a mandatory mortgage payment. When I took out the loan 10 years ago, I think, at 2.5% interest, which is a heck of a good deal, I made a commitment for 30 years, and my mortgage payment is $800 a month. Isn't that beautiful? Isn't that beautiful? Right? If I were to buy my house today, my mortgage payment would probably be $3,500 a month, because my home has gone up in value substantially since when I did the loan back during the low interest rate days and lower home value days. But it sure is nice. It sure would be nice that if I had the option of not making a mortgage payment, that I could do so. $800 a month is $10,000 a year worth of more money in my pocket for retirement. Now, I'm still young, and one day I will be able to do my own HECM. I don't want to do a proprietary HECM because I don't need the money right now. I'll wait for I'm eligible for the FHA because the interest rate's lower. That's probably the primary reason. I like the lower interest rate. But all right, any questions? All right. So when does this loan due? It's due at the end of life, or when the borrower quits living in the property. Maybe they're still alive, but they've decided to sell. Maybe they've moved away. Maybe they decided to move in with their kids. Maybe they've moved into a nursing home, right? When they're done with the property. And it doesn't matter if they're 80 years old or 110 years old or 140 years old. It's just when they've decided that they can't live in the house, don't want to live in the house forever. It ceases to be their primary home. So it's whenever that is. What if a spouse passes away? Well, as long as there's one spouse living, you're fine. There's no due date just because a spouse dies. You got to pay the taxes and insurance, right? The HOI, homeowners insurance, the property taxes, the association dues. You got to pay that because that's part of any mortgage contract. That's when the mortgage is due. So in order to get an FHA, all borrowers, the key word is borrowers, have to be 62 years old. For the proprietary, it's 55. For the proprietary, both spouses must be 55. For the FHA, the borrower must be 62. The non-borrower can be of any age, all the way down to age 18. And there's some true stories that have come around. I'll tell you one right now. I had a 7-year-old who was considering doing a HECM with a 25-year-old wife, and that's not a joke. Yeah, there's a story behind that. It's an interesting story, but I'm not going to tell you because I'm pressed for time because we had a delay getting started. But that's pretty cool that both spouses get full protection under this program, even if a 72-year-old person is married to a 25-year-old person. They're both protected. The loan comes due when the last remaining spouse leaves the home permanently. Now, that may be a little bit confusing what I just said. The borrower must be 62. So using the same example of a 72-year-old married to a 25-year-old, the 25-year-old is not a borrower. They're a legal spouse and they have protections under the program, but the borrower is 62, which is our client who's 72. So once we close on this loan, then all spouses are protected, no matter what their age is, which means that in this case, she cannot be displaced because she's 25 years old. She can live in this home for the rest of her life. Pretty cool. And that does happen, not so much a 72 to a 25, but a 62 married to a 52. That's not uncommon. 82 married to a 59, right? It happens. So they do not have to be a U.S. citizen, but they have to have the right to live in this country. Okay? They must have the right to live in this country. So a green card, they have to have a social security number, bottom line. They have to have a social security number. If they have a social security number, then they have the right to live in this country. All right, any questions?
No.
All right. Whoops, boy. Sensitive keys here. Okay, so what properties work? Well, no second homes, must be a primary home. No second homes, must be a primary home. Single family residences, call them a townhome, call them a villa, call it a cluster home, call it a modular home. Brand new construction, as long as the CO is issued. It can be a duplex, a triplex, a quadplex, not a fiveplex. Fourplexes and under are considered residential properties. Condominiums are okay as long as they're FHA approved. Very few of them are. That's because of the housing crisis. For portfolio HECMs, we fill out a condo questionnaire, which is really no different than a regular forward mortgage. Not hard to get condos approved. Interesting enough, the word condo is just a way of titling a property. And a lot of people don't realize that a condo could be a single family home community, stick-built homes in a land condo. There's also land condos with manufactured homes on them. All over Florida, there are manufactured homes in land condos. we can probably get it done as long as the wording is done properly. Don't go market land condos. Definitely don't go market co-ops. If you don't know what a co-op is, Google that. But leased land can be difficult because most of the time they're not worded properly for FHA, but we can definitely do the portfolio loans with them. So leased land is very common with manufactured homes. The manufactured home has to be a 1976 or newer. There's all sorts of rules, but the quick answer is that with exception of condos and manufactured homes and condo lands and leased land, pretty much every home out there qualifies. That's the quick answer. Modular homes are considered stick-built homes, cluster homes, villas, zero lot lines, row houses up in, if you go to Baltimore and some other cities, there's row houses. So pretty much everything qualifies under FHA, and just about everything qualifies under the proprietary loans. So down payment. Now here's what's interesting, is you cannot borrow money to make this program work. One of my agents always says you can't borrow money to borrow money. Okay, I guess that makes logical sense. You have to have your own money. You cannot go out and borrow money in order, look, I got down payment money. No, it's got to be your own money. You can get it from your checking, your savings, your CDs, your IRA, your investments. You can go sell another home and use that as an asset. I had a guy sell a car on eBay, had a PayPal receipt showing that he got his money. It was his asset. He could prove that he owned the car. He didn't borrow the money. He sold the car. I had a guy who had a bunch of gold bars, had serial numbers, had the receipt from where he bought the gold 3 years ago. He cashed in his gold bars, got the receipt with the serial numbers. All right, that was an asset. He sold the asset, had money. He didn't borrow that. You can actually get gifts. As long as you don't borrow the money, you can call up a good friend and say, look, can I have $50,000? That's actually a true story. And I had a gentleman who got $50,000 gift from one of his best friends. I don't know if they had a side deal. I didn't ask. But the point is, it wasn't borrowed. I had a customer who reached into his life insurance policy and cashed it out. Figured I didn't need life insurance. I'm 75 years old. What do I need life insurance? I'm dead and buried. I've already got a prepaid funeral. I don't need life insurance. My kids are all grown. My wife is fine. Okay, makes sense. So you can't borrow money, but you can get gifts, and you can get gifts from family. You can get gifts from friends. And that's one of the unusual things that's one of the unusual things for the HECM is you can actually get it from friends as opposed to the FHA regular financing. So you cannot borrow money to borrow money. You cannot go and get a home equity loan from a second home. You cannot get any kind of subordinate financing. In other words, a first-time home buyer program, a down payment assistance program. In a sense, that's borrowing money. You can't use your credit card to get cash. You can't get a loan against anything. Now, if you were to borrow money from a second home or get a cash advance on an asset, the way around that rule, which is completely allowed, is you put the money in your bank account and season it for 2 months before you apply for a HECM. Now, there's no lies here because someone's going to look at your credit report and say that you got a home equity loan from a home that you own in another state. As long as your debt-to-income ratio fits the guidelines of FHA, remember the 527 down plus all your expenses, the property taxes, homeowners insurance, as long as your debt-to-income ratio fits within that 527 plus outside expenses, you qualify. And as long as you've seasoned the money for 2 months, it's okay. It's okay to have a second loan from another property. I had a person ask me one time, well, is there a limit on how many properties you can own? No, you can own 50 homes if you want to, but can you afford 50 homes? Can you afford the monthly payments on 50 homes, and do you have enough income to substantiate all that debt? And the answer is yes. You got the documentation. You've had those homes documented income for at least 2 years. You're fine. Okay. Geez, there we go. So out-of-pocket costs. Here's the question I had earlier was, what are the closing costs? Well, the closing costs, they're always important, of course, but they're financed into the loan, doesn't come out of your borrower's money. So they're not really that important. What the real question should have been, could have been, is, well, what does the borrower have to pay? Well, first of all, they got to pay the down payment, the 65% of the home's purchase price. In addition to that, they got to pay for the appraisal, $625 on average. If they're buying $1 million home, maybe that appraisal price is $750, $800. There's going to be HUD counseling because this is a federally insured loan, at least the FHA HECM is. You have to go through mandatory housing counseling. It's very specific to the reverse mortgage industry, HECM industry. It's going to take about 30 minutes, maybe 20 minutes. I know that says 30 to 60, but yeah, realistically, it's under 30. And the counseling agency, the nonprofit HUD agency, is going to charge about $150 to get the certificate of counseling. We need that to get the process started and closed. So out of pocket is going to be those two primary things. Now, if they're buying a home, they also may want to do a home inspection, so they'll pay for that. And earnest money obviously would have to be paid out of their pocket, and then it would be reimbursed upon closing. What else? If they get a home warranty, that's on them. But the loan cost itself, that's what comes out of their pocket. So as I mentioned before, what are the rest of the closing costs? You have your third-party fees, all the stuff that you're aware of, doc stamps, intangible tax, right, all that stuff. Then you have FHA's fee of 2% of the purchase price. So if it's $1 million home, 2% is 20 grand. It's 2% of the purchase price, not the loan amount. If they buy a $100,000 home, it's a $2,000 fee. It's just that simple. It's 2%. It's the FHA upfront fee to do this loan. Now, portfolio loans don't charge that, but they have a higher interest rate, so they do charge it in a different way. And then the origination fee has a cap of $6,000. And the FHA lending limit, which we're going to go over in a little bit, is $1.249 million. And we'll go over that in detail in a little bit. All right, I'm still looking for questions. All right, so don't forget, hang on, let's see if there's a question in here.
You know what I wanted to mention, Tim? Is that when
Yeah,
you're
go
talking about making payments, people can make payments on this program. The beauty of making payments on this program is that the money you make, the payment you make, not only reduces the balance on your mortgage, it also goes into a line of credit. And the line of credit increases at about 0.5% more than what the interest rate would be in this particular case. The money in the line of credit would increase 6.5% a year and is available to you anytime you want it.
That's right.
So it's a very good program. If you decided you want to make a payment here or there, you can make the payment in any amount at any time, but you can also withdraw the money if you need it in the future, or if you want it, whether you need it or want it.
Yeah, thank you, Don. And I'm gonna repeat what Don said in a different way. Not that Don didn't do a great job saying that, but sometimes we hear things twice in two different ears. So picture this, and I've met people like this. I'm gonna give you an example. That's a better way of saying it. Picture this. Someone is retiring, or they're changing their primary home. They're buying their next home using a HECM. And you show them this program. I've had customers say this to me, and you say that there's no required payments. And they're going to say, what they could say is, but I want to make payments. And you might say, well, yeah, but you're going to be going into retirement. And you may not want to, but I do. Well, why would you want to do that? Well, because I want to leave my house to my kids as much paid for as possible. Okay, that's fine. Now, first of all, kids don't want the house, right? They want the money from the house. They're going to sell it anyways, right? Any realtor who's been in the business long enough knows that most of the time when someone inherits a house, they sell it most of the time. So that's what the kids are going to do. It's a nice gesture that parents want to leave their house to their kids. In reality, kids are going to sell the house. They want the money, right? They want the money. But let's go back to the story. Let's say someone does want to do that. They want to make payments. And let's say that the interest each month comes out to $1,000. And they don't have to pay it, but they want to. So they do. They do a HECM, but they make a payment because they want to. Here's the beautiful thing about this. Is everyone listening? What Don said is so true. So your client says, fine, I get my monthly statement. It says $1,000 in interest. I pay the $1,000. It pays down the mortgage balance, or at least goes to pay the interest, so it keeps the mortgage balance the same. And it pays down the mortgage balance. The identical amount that they just paid also goes into a line of credit. So it pays down the mortgage balance, but it also goes to a line of credit. And the beautiful thing about this program is at any time that the borrower wants their money back, they just call up the servicer and say, I've been making payments for the last 5 years. I got $60,000 worth of payments, and I wish I hadn't made those payments. I didn't expect my spouse to die. I didn't expect the roof to leak. I didn't expect I needed a new car. I didn't expect to live so long. I wish I had not made those payments. The lender will send them their $60,000 back. We'll send them every amount that they want. Anywhere from nothing to $1 to $5,000 to the 100% of what they paid in all those years. They'll send it back at no charge. It's a refund of monthly mortgage payments made because it wasn't required. Because it wasn't required. They didn't have to make the payments. So FHA put this into the program. If you change your mind, we'll send the money back to you. And the second thing that Don said was they're going to grow the line of credit by approximately 6.5% over all those years. So in addition to the 60,000, they got a 6.5% growth. It's like putting money into a savings account, into a CD with a 6.5% interest rate. They're going to grow that by 6.5%. Yeah, yes, you heard me right. They're going to refund the money at no charge plus give a growth of approximately 6.5% compounded. Is this the best program on the planet or what?
Yes.
This is why I love the program so much, because it is not only the safest loan in America, but it's the best loan in America. Was there a question? No question? All right. This is just a fantastic program. I can't even imagine how someone will poo-poo this without even understanding anything about it. I've just heard bad things. Well, tell me what you've heard bad. By the way, this is a question for your clients. When someone says, "Yeah, I don't want a reverse mortgage. There's too much bad press out there. It's, it must be bad." Like, how is it bad? I don't know. I've just been told. Well, who told you? My gosh, my son's best friend's mother, her brother's neighbor did one of these reverse mortgages, and they lost their house. How did they lose their house? I don't know. They just did. Did they not pay their property taxes? Did they not pay their homeowner's insurance? Because this is just a mortgage with no required payments. How did they lose their house? Well, they got cancer, and then they had a lot of medical bills, and they used all their credit cards, and they got in financial trouble. And okay, how did that involve the reverse mortgage? Well, they just couldn't pay their bills. Oh, good thing they didn't have a mortgage payment. If they did, they would have lost their house too. Well, they did lose their house. Well, how come? I don't know. Well, it wasn't because of the reverse mortgage. If anything, the reverse mortgage saved them for as long as it could, until you didn't honor the contract. You didn't pay your property taxes, your homeowner's insurance, your HOA, because the reverse mortgage you cannot default on unless you don't honor the rest of the contract, such as paying your property taxes. Right? Any questions? Any non-believers out there yet? Not ever, because there is no reason not to believe this. Now, I'm not going to get into financial planning because we don't have time. It's 20 minutes till the top of the hour, and I'd like to get done a few minutes early, but we're going to skip over most of this. But what I do want to say is that financial planning and a reverse mortgage goes hand in hand, because you can. Oh, Tony raised their hand. Okay, I'm going to pause. Tony, go ahead.
Yeah, I have a question about how does this work if the benefits outweigh how long you live? I mean,
Yeah, you can't.
If you don't die when this is all back to zero, you don't owe anything more, and the house is no longer yours, then what happens to you?
Okay. So, first of all, you cannot outlive this loan. It's a lifetime loan. What is the definition of lifetime? Forever, until you die.
Really?
So you cannot outlive it. But the second part of your question is a good, very good question. All right. What happens if you set up a line of credit? You close this, and your $500,000 house gives you $200,000 in a line of credit. And let's just say I'm gonna be really generous with your question. let's say that you're 62 years old, and based on your home's value and your age, and you're able to set up a $200,000 line of credit. You don't even need the money. You've decided to retire, you've got a $200,000 line of credit, it just sits there. But over the next 20 or 30 years, you've been chipping away at this $200,000. And maybe now you're 85 years old and you've used up your entire 200,000. Now I'm on the right track, right, Tony?
Yes.
Okay,
Yeah.
so now you've used up your last dime of your $200,000. Now, never mind, remember we have a 6.5% growth rate. So your $200,000 line of credit's been growing. All right, over the last 20 years, your line of credit's grown to $275,000. But guess what? You spend it all, right? Things happen. You got to get a car. Your roof has been leaking. You've had some round the world cruises that you planned. You know, you helped your daughter buy her first house, your grandkids through college. You've spent all your money, and you're 82 years old, 85, and you're still full of life. You're still as young as you were 20 years ago, but you're out of money. And maybe worse, now I'm going to paint a bad picture. Now, even worse, your home has dropped in value. You've spent all the money, and your house is now only worth 250,000, but you owe 250 or 275. But you're still young and you're full of life. Guess what? Nothing bad can happen. This is a HECM, right? The house is not worth what you owe. Well, guess what? You're not selling your house. It's a lifetime loan. So what if your house is worth $1 million or worth 250? It doesn't matter. No one's come back and reappraise it. It's a lifetime loan. But there's no more money. Well, I'm sorry you spent it all, but it doesn't mean the loan comes due. The loan is still as solid as it's always been. There's no money left because you spent it, but it's not called. The house is underwater. You don't have any money left in your line of credit, but the loan is strong as it's always been. It's not being called due. You got to pay your property taxes, your homeowner's insurance. You've had a great 20 years. Well, now you're going to have to tighten your belt and live within your means. So the answer, hopefully I answer your question, is this loan never comes due until you're done with the property because you've died, you've moved out, you didn't honor the contract, you didn't pay your taxes and insurance. Whether you have money left over in your line of credit or not doesn't affect the loan terms.
Huh.
Is that good? Is that a good answer?
It is. I can't figure out how you do that.
Yeah, well, for a couple of reasons. One is, you bought the HUD insurance, that 2% of the purchase price. You're buying the insurance, right? It's what keeps the program alive. And for the rest of the story, what does HUD do with this 2%? They've done well over 1 million loans over the last 35 years, these HECM loans. Probably 2 million by now. I remember 12 years ago, we hit the 1 million mark. It was a big industry-wide celebration that we finally hit 1 million loans. Now it's probably 2 million loans. But where does this money go? Well, HUD puts this 2% fee plus a half a point a year into a trust fund. The trust fund has hundreds of billions of dollars in it. So it's just waiting for a bad situation to happen. The economy fails. Your example of your customer comes true where the house is now underwater, but they're still paying out. They're still, the loan is still active. Because if the house doesn't recover because of the downturn in the housing economy, because I just used a bad event, but let's say it recovers now, it's worth $700,000 like it's supposed to be. If the property value doesn't recover before she is done with the property, let's say she dies, then HUD has to bail it out. And how do they bail it out? They reach into the trust fund, not the taxpayers, but the trust fund to bail out this underwater house, but only when she's done with the property.
So I have a question then. So if the loan, say just for easy numbers, it's $1 million, someone's purchasing $1 million house, they have to put $700,000 down. And then they have to pay 2%, which is another $200,000 to HUD. So in essence, they're paying $900,000 for a $1 million house.
No. You're on the right track in the beginning. So the down payment's going to be somewhere between $650,000 to $700,000 on $1 million property, depending on the person's age. Okay.
Oh, okay.
So that's the first thing, but that includes all the closing costs. That's their down payment. To make it simple for you, the realtor, is When I say the down payment is going to be between $600 and $700,000, depending on the person's age. In other words, if they're 82 years old, their down payment's probably $600,000. If they're 62 years old, their down payment's probably $700,000. But
Okay.
both your customers, 82, 62, are going to be buying $1 million house with a $700,000 or $650,000 down payment, including the closing costs. The
So that
closing
includes
costs,
that 2%. That 2% is already in that number.
correct, and the 2% on $1 million is 20,000, not 200,000.
Oh, Jesus. Okay. Yep.
Yeah,
Math.
yeah, that was just bad math. That's why we don't want to
Yeah.
do math on
I
our
was like,
interviews.
hold on, hold the phone. That doesn't make sense. Okay. Yep.
Yeah, so they're going to put they're going to put $700,000 down. The lender, FHA, the lender is going to put down 300,000, and including the closing cost. So the seller is going to get their $1 million asking price, and then the title company will take the $1 million that was just received from the buyer and the lender, and they're going to pay out all the debts. They're going to pay the realtor fees. They're going to pay the closing costs. They're going to pay HUD their 2%. They're going to pay the doc stamps and tangible tax. The bottom line, the borrower put down the 700,000. The lender put in 300,000 plus the closing costs, and everyone gets paid.
Okay. And then that interest, basically that interest rate of 6%, if it's FHA, goes based off of 300,000 for the life of the
Correct.
loan
Just
plus
like that.
interest. Yeah. Okay.
Well, that is it. Yep, yep. Okay, so again, we have to go rush through this part real fast because we're about 10 minutes away from being done, and which is fine. We're right on track. But what I want to say is that cash and cash flow is king in retirement. Financial planners, when they understand the HECM, love the program because it keeps their financial portfolio intact. Because once you spend your assets can never make money ever again because it's gone. So you don't want to be spending assets. You don't want to be spending money. You'd rather borrow the money, especially money that you don't have to pay back in your lifetime. So financial planners love this. You can also use it to delay Social Security, especially if you're 62 years old. You have the option to draw on Social Security, but you're still working, right? You may want to look at that income tax wise. It might affect you. I know under the current administration, they're trying to do away with the Social Security income tax, which would be a wonderful thing. And I think it's going to happen. I just don't think it's happened yet. But you can delay Social Security, and every year that you delay Social Security, you get an 8% raise. So if you can delay it to full retirement age of 67, that's a good thing. If you can delay it to age 70, that's a good thing, unless, of course, you have a short life expectancy. But the HECM is a way to give your financial plan some breathing room, something worth considering, anyways, at 62. So again, Social Security is a good option, a good way to delay that. I'm going to skip through all these slides, and you'll get a copy of all these slides if you have any interest in reading this. So what's next? Well, you identify a home buying senior, and don't be afraid to ask them, are you 62 or over? Don't be afraid to ask them that. That's a fair question. It's a fair question. It doesn't discriminate against anybody because if they're under 62, they don't qualify for the FHA HECM. So no sense even talking about it. If they don't qualify, they don't qualify. You won't know unless you ask them. Are you 62 or above? Now, if they say, well, I'm 56, and you know that they've had a bunch of money for a down payment and they don't want to pay cash for $1 million home, well, then we have the proprietary loan available at age 55 plus. Now, it may be too young because the loan to value is not that great, but maybe it makes sense for them. We close these things in about 4 weeks. You fill out a sales contract the way you would normally fill out a sales contract. We'll take care of the income and asset verification. As I mentioned before, 886 for a married couple is the minimum income plus any plus any expenses that show up on a credit report plus the property charges. So taxes, insurance, HOA, things like that. If they're single, 529 plus those fees. They cannot be delinquent, keyword delinquent, on any federal debt. So they owe, if they're defaulted on student loans, and yes, seniors have student loans, either because they co-signed or they went back to school. If they defaulted on an FHA or VA loan, can't default on the federal government because they won't loan more money to you if you defaulted on the federal government. And if you owe back taxes. Now, it's okay to owe back taxes, but you better have a payment plan with them or it's delinquent. The government doesn't like to be defaulted on. We don't have that debt to income ratio like conventional, like that 42%. We don't have that. If they had $10,000 a month in income, but $9,000 worth of expenses, guess what? They qualify because they're less than 886 if they're married. So it's pretty easy to qualify for this program in most cases. So no credit score requirement except for the portfolio, which I think they're down to 620, so no big deal. Sales contract, fill it out the way you normally fill it out. There's nothing fancy. If we're doing the FHA version, check off the FHA financing box. Other than that, we don't have all the stuff that regular loans have. We don't have TRID. We still use the HUD-1. We don't have a settlement disclosure. It's different. If the seller wants to offer concessions, we accept that up to 6%. If they were doing the FHA purchase, there's a mandatory clause form in the real estate certification form. If you don't know what that is, we provide it, no big deal. Everyone signs it. I had a realtor told me they were afraid to do this because they didn't want to make a mistake on the sales contract. I tell you, you know what the number one most important thing on a sales contract is? Number one most important thing. It's the customer's signature. Anything else can be fixed with an addendum, right? Don't be afraid of making a mistake. And someone asked me, what's the average age? It doesn't really matter. 72 is the answer. But I have clients that are 96, 98. One of my employees did a loan for a 107-year-old. 107, yeah, you heard me. 107. 55 is minimum, 62 for FHA. It just so happens 72-year-old seems to be the sweet spot. Don't know why. It just is. And why would this 107-year-old do a HECM? Well, in this case, they needed home care. Couldn't take the house with them. Why not mortgage it? Use the money to stay at home. Makes sense. What about the kids? It's not about the kids. It's about mom and dad. It's about making sure they have the best life for the rest of their life, right? We all want inheritance. We do. But it's not about us. It's about mom and dad. All right. So as I mentioned before, the lending limit for FHA. Now, I'm not sure if I like the word lending limit because it makes it sound like FHA is willing to lend 101.249 million. No, they're not. FHA is willing to consider the house to be worth 1.249. Then they do the calculation. 60, 65, 70% of that is what FHA wants to have as equity. In other words, they'll lend the difference. Right? So I don't really call it the lending limit, but that's what FHA calls it. So on a proprietary, there is no lending limit. It can be a $2, $5, $9, $19 million house. It doesn't matter. On FHA, you can certainly do a $1.5 million FHA HECM. You can certainly buy a house that's worth 1.5 million, but FHA is going to consider it to be worth 1.2 million for the purpose of the calculation. Then the borrower would pay the difference dollar for dollar. So I think it was Tony, using your example before, you've got a client who wants to buy a $1 million house, they're going to put $700,000 down. Okay, that works. The same client changes their mind and wants to buy the $1.5 million house. Okay, so FHA is going to take the 1.249 million and do the calculation, 70%. All right, I'm going to do quick math in my head and say that comes out to 900,000. I don't know. So the down payment is 900,000. But the house isn't 1.2 million. It's 1.5 million. So dollar for dollar above the 1.249 is $251,000, right? So they're going to put $251,000 down. That brings it down to the 2.49 million. Plus, they're going to put the difference between 2.49 million and 900,000. So the quick math is they're going to put $500,000 down and purchase the $1.5 million house. It's still a great deal, right? They're putting more than 30% down, but so what? They're buying a $1.5 million house for $1 million. Great deal. All right. Now, I made this slide a long time ago when the lending limit was, oh my gosh, at one time our lending limit, well, when I first started, the lending limit was 115,000 because the average home was 115,000. And then it went to 135. Yeah, I've been in the business 26 years. Then it went to 135, then it went to 150, then it went to 189, then it went to 210, then it went to whatever. It finally got up to $419,000 lending limit. Man, those were the days because home values weren't anywhere close to 419. We never got that high.
I mean, certainly there's always been homes that's worth millions of dollars, but we never got that high. And then a few years ago, FHA decided to lift the cap all the way up to like 800 and something $1,000. Man, I've never done a $850,000 HECM for home purchase or HECM refinance, and that was great. Then it went to $1 million, and then it went to 1.1 million, then it went to 1.2 million. Holy crap. But when I made this slide, $1 million was a lot of money. The average home now is 400,000 in the state of Florida. The average home. And then it went. So this slide is no longer as impactful. So when I made this slide, I thought it was funny. Can you do a HECM for home purchase on $1 million house? Yes, you can. Yes. That was so exciting to me. All right, not so much anymore. All right, we have 3 or 4 minutes, so let me just move really quick through here. And then we'll open up for questions for those who want to stay longer. So your job as a professional realtor is to get the phone to ring, not those crank calls and the spam calls, but just get the phone to ring. You don't care if someone calls you that's 40 years old asking about the HECM for home purchase. Now, they don't qualify, but they want to buy a house. That's all you want. So you don't do a HECM. You help them in with a VA loan, or you help them with an FHA loan, or you help them with a conventional loan. But they called you, right? You've got a home buying person of any age calling you. That's all you want. And whether you help them into a HECM, that's great because that helps our industry, or you help them with a conventional loan, that helps your loan officer down the street. Doesn't matter to you. You're making a sale. So here's some Florida statistics. There's 13,000 baby boomers turning 62 every day in this country. 13,000 people every day. That's amazing. 1,000 of those people are moving to Florida every day. Doesn't matter what their age is, they're moving to Florida. That's a good thing for our economy. 24% of the home buying population in Florida already here are 62 and over. That's pretty cool. 24% of everybody is already the age for a HECM. 35% of all home sales, according to NAR, were sold to people 62 and above. Think about that. 1 out of 3 sales in Florida are sold to people. And how come all of them aren't doing HECMs? You know why? Because only 3% of the realtors even know this program exists. You guys can add yourself to that 3%, and that's congratulations to you. 40% of the U.S. population is planning on moving to Florida in retirement. I'm joking there, but still, 40% of the population is planning on moving in retirement. That's a lot of people. 77% of the nation's wealth is controlled by senior citizens. Those are the cash buyers that we're talking about. You're probably not going to have very many 30-year-old cash buyers. There's nothing wrong with cash buyers, especially when you combine it with a HECM. 86% of the seniors want to age in their own home. Now, there are several ways to look at that. That means all those people living in homes that are not compatible with seniors, such as narrow hallways, 2-story homes, 2-story townhomes, maybe a manufactured home without the proper handicapped accessibility. These are listings. You sell a house, you help them into the next house using a HECM. 2 sales. Think about it. 96% of seniors who have completed HECMs in the past are completely satisfied. Again, that's like a 9.9% rating, 99.9% rating. That means 4.9 stars out of 5 stars. I mean, that's just amazing. So why should you target the senior market? Well, they've got the cash. You're going to be changing their lives for the best. It feels good. You're going to make more money. Seniors socialize with seniors. Seniors will tell their friends they got a brand new house using a HECM. They've moved from one side of the 55 plus community to the newer side of the 55 plus community with no cash out of their pocket. They sold their former home, they bought a nicer home with no additional money out of their pocket using a HECM. All right, we're going to move right through these, and this is interesting. You're allowed to do this, by the way. You can put this on MLS. See the second to last sentence? You can put this on MLS, by the way. It's been approved. Just one large down payment and no monthly mortgage payments. Think about that. There's nothing in there about age. There's no age discrimination. You're not breaking any rules.
You buy this house with just one large down payment and no monthly mortgage payments. Ask me how. A 40-year-old sees that. Well, how do I do it? Well, you have to be 62, 55, right? It's allowed, especially if you put it under the, was it agent comments? In other words, just the agents see it, not the general population sees it. Then you're definitely not, you can't even be questioned because it's agent to agent communication. Okay. Oh, here's something. We mentioned earlier about duplexes, triplexes, quadplexes. What's interesting, if your client wanted to buy an entire plex, they could live in one and rent out the other three and keep all the money and have no mortgage payment on any of the units. Digest that. Talk about wealth increasing, talk about cash flow increasing, talk about everything, right? Let's just say that you have a quadplex. I'm going to just use the max. Let's say you have a quadplex for $1.2 million. You have a customer who happens to have $800,000. They could buy one unit. They buy all four units, live in one, rent out the other three at, let's say, $2,000 a month, $2,500 a month, whatever that number is, $2,000 a month times 3 units that they're renting out. They got a $6,000 a month cash flow and no mortgage payment. Buy a duplex. Same math, less math, but same math. Very good. All right. So officially we're done. You guys are welcome to sign off. If you want to stay back and listen to some questions that people may have, I'm here for questions.
Yeah, I have one question. When you how at the end of the loan, if in fact they were upside down, you could just hand the keys over and be like, I'm done with no like issues. Now, what if they want to turn around and purchase another house? Can they use a HECM loan again or no?
They can. Believe it or not, no recourse means no recourse.
Okay.
They absolutely can because it's not considered a default. They could. They could, absolutely. Yes.
Okay, great. Thank you.
Yeah. I don't think
That's a
anybody has
good
ever asked
question.
that question. It's a fantastic question. I'm not just saying it's a good question just to humor you. No, that's really a good question because
That is a good question.
I'm smiling. Look at my smile because that's a good question. Yes, it's a non-recourse loan. They could default. They could hand the keys back and turn around the next day and close on the next one. Yep.
Like, I just feel like this loan could be used for so many more things than just like elderly, like I feel like even if they're not retired and they're 62, I mean, they could use this as just, even if they're planning to downsize later, they could still use it.
Well, okay, let's talk about that for a moment because I like the way your brain is working. There are so many ways to use this program to increase a person's net worth, to increase a person's cash flow. People think if you do this, you're eventually going to be broke because you're not making payments, you're spending your money, and you're going in the hole. No, thinking outside the box, the duplex option, you buy one, buy two, live in one, rent out the other. All you're going to do is increase your net worth. So on that same line of thinking, I have met people that have done this. And for those forward thinkers, okay, hang on a minute. I'm 62 years old. I don't need the money. My wife is working. I'm working. My credit score is 850. Life is great. I have a $500,000 home. It's paid for. I don't need a mortgage. Now, in the future, after I retire and one of the spouses passes away, my income drops, I might. But right now, life is good. Now, for somebody who thinks this way, that are smart enough to realize the future, here's what they could do and probably should do. And I would definitely want to get a financial planner involved to run the numbers. But based on their age, they might qualify for $160,000 line of credit. They don't need the money. So they're going to do a HECM now. They're going to have a $160,000 line of credit. And again, we're thinking outside the box here. And the interest, we call it a growth rate because it's not interest, it's growth. There's a reason for that because interest is taxable, growth rate's not. But they're going to get a 6.5% growth rate on $160,000. They don't need the money. So that means next year they have $170,000 in their line of credit. They don't need the money. So next year they have $180,000 in their line of credit. The house is worth $530,000 now. They don't need that either. And effectively their house is still paid for, right? Because they still have the line of credit and they haven't used it. And now they have 195,000 in their line of credit. Now they have $215,000 in the line of credit. Maybe by the time they're 67, they have $250,000 in their line of credit. Their house is worth $600,000. And now they've decided to retire. They got 250. They started with 160, but now they got $250,000 in the line of credit. And maybe they need the money, maybe they don't. And maybe they haven't been drawing Social Security, maybe they have. But the point is they got all this money they didn't think they had. But then something happens. They decide that they want to retire in style. They decide to take that 120-day around the world cruise. Maybe something tragic happens. Their spouse dies. The roof leaks. Their Ferrari got repossessed. Yeah, I'm making this up. But, they decide to downsize to a Cadillac. They could reach into their line of credit and pay cash and never change their financial situation and use the growth from their 160 and never touch their principal. And they still own the house. So why not think ahead? Why not do this when you don't need the money and let it grow? Right? Thinking outside the box. Never touch their portfolio, all their investments, all this money in the stock market, their IRA money, their qualified money that if they take, they have to pay taxes on. Leave it alone. Let it grow. Let it compound. Use the money from the line of credit that's not taxable because it's a loan, that doesn't affect their net worth, right?
Okay, thank you.
All right.
All right.
Thanks,
Thank you
everybody,
for attending.